Okay, so let's recap. Capital budgeting, why do companies do it? They have only certain resources. So resources are scarce, there's only so much of it, and if they're going to invest in a long-term project, then they would like to, in some ways, to compare the projects. And we have different tools that are available. We have the payback period, the accounting rate of return, the net present value, the internal rate of return. So those are the four that we have. So let's talk about the payback period first. The basis of measurement, we look at cash flow. Okay, and how is it expressed? It's expressed in the number of years. How many years before we receive our money back? What are the strengths of it? It's easy to understand. It's a simple back of the envelope calculation. It allows comparison across projects. It doesn't consider, but the limitations, and the biggest one is it doesn't consider the time value of money, and it doesn't consider cash flows after the payback period. The second method that we used is the accounting rate of return. The basis of measurement is accrual income, and the measure is expressed as a percentage. Okay, and generally when you see the word rate, that means percent. You should be able to see as percentage. What's the strength of the accounting rate of return? It's very easy to understand. Allows comparison across projects. The limitations, again, it doesn't consider time value of money, and it doesn't give annual rates over the life of a project. So that's the accounting rate of return. The net present value, the basis of measurement is cash flows and profitability. It's measure expressed as a dollar amount. What is the net present value in a dollar amount, basically. Strengths, finally, it considers time value of money, and it accommodates different risk levels over a project's life. And the way to think about that is if you don't receive your money today, the likelihood of you receiving it in the future slowly starts to decrease. So there's a different risk levels. Okay. Limitations, it's difficult to compare dissimilar projects. So that's a disadvantage. And finally, the internal rate of return. The internal rate of return, cash flows are used, and as well as profitability. The measure is expressed as a percentage. And the strengths are it considers time value of money, just like net present value. But it does allow comparisons of dissimilar projects. And that was the disadvantage of net present value, but the internal rate of return allows that. However, a limitation is it doesn't reflect varying risk levels over the project's life. So these are the four capital budgeting tools that we've learned in this chapter. And you should know each one, the strengths and weaknesses of each one. How do you calculate it? And just simply go back through the calculations that we've done, and always write down the formula first in words, then plug in the numbers, and then look at the number that you have and understand what does it mean. Okay, and that's the end here.